Let's talk about something that hits close to home for pretty much all of us: retirement. What if I told you that the safest, most common sense advice you've ever heard about saving for it is, well, just plain wrong? What if it's actually holding you back? Okay, let's get into it.
You know the rules. For years, we've all been taught this very specific playbook for retirement investing. Millions of us follow it. It's built right into the financial products we use every day. But what if that entire playbook is based on a shaky foundation, a flawed idea of what risk really is?
So before we start tearing down the old way of thinking, let's just make sure we're all on the same page. Let's do a quick refresher on the advice that, let's be honest, you've heard a million times from financial advisors, from books, and probably from your own 401k provider.
It really all boils down to these two golden rules. First, you diversify. Don't put all your eggs in one basket, right? You split your money between stocks for that sweet, sweet growth and bonds for safety. And second, as you get closer to retirement, you start to de-risk. You sell off those volatile stocks and buy more safe and stable bonds. It sounds completely logical. It makes perfect sense on the surface.
And this isn't just some abstract theory. For most of us, this is all happening on autopilot. If you have a 401k and you never really dug into the investment options, chances are you were automatically put into something called a target date fund, or a TDF. Think of it as your retirement plan's cruise control. It just follows those two golden rules for you, year after year. It is the definition of the status quo.
Okay, but now for the fun part. We're going to look at some brand new research that essentially takes a sledgehammer to that entire way of thinking. A fascinating paper from 2024 crunched over a century of global data to see if these universal beliefs actually hold up. The paper is called Beyond the Status Quo.
The name says it all, doesn't it?
The authors looked at data from 39 different countries going way, way back. And with all that data, they ran millions of simulations of different retirement scenarios to find out what the truly optimal, best-case strategy actually is. And this is what they found. I'm just going to read this quote right out of the paper because it is absolutely wild. The best portfolio? 100% stocks. No bonds. Zero. Not when you're 25, not when you're 65. A simple mix of 1/3 U.S. stocks and 2/3 international stocks. This just flies in the face of everything we've been told.
So, how could this possibly be true? To figure that out, the researchers basically set up a head-to-head showdown, the old-school conventional target date fund versus their new, data-driven, all-equity portfolio. And let me tell you, the results are pretty jaw-dropping.
All right, so in one corner, you've got the reigning champ, the typical target date fund, playing it safe, getting more conservative over time. And in the other corner, the challenger, this radical all-equity strategy, staying 100% in stocks all the time. Let's see who wins.
So first up, how hard do you have to work to reach your goal? Well, according to the study, if you're in a standard target date fund, you'd have to save 61% more of your own money to end up with the same amount at retirement as the person in the all-equity portfolio. Just think about that. That's a massive difference coming out of every single paycheck.
And this chart really just says it all, doesn't it? Look at the difference in the final outcome. On average, the all-equity strategy gets you to over $1 million by retirement. The target date fund, you're looking at about $770,000. That's a 39% bigger nest egg just based on the strategy you chose.
But honestly, this is the one that really blew my mind. The whole point of shifting to bonds is to be safe, right? To make sure you don't run out of money. Yet the study found that the safe TDF strategy has a nearly 20% chance of failure, of you running out of money in retirement. The supposedly riskier all-stock portfolio, only a 7% chance. By that measure, it's almost 3 times safer.
So the big question is, why? How on earth can a 100% stock portfolio be safer in the long run than a portfolio that carefully mixes in safe bonds? The answer really forces us to completely rethink what risk actually means when you're investing for the long haul.
This is the question, right? It goes against every instinct, everything we've been taught. Well, according to the researchers, the key is understanding the hidden dangers of bonds and the misunderstood power of international stocks, especially when your timeline is measured in decades, not years. Okay, this table here is where we find the secret sauce. Check out this data for a 30-year horizon. First, look at bonds. Their average real return, that's your profit after inflation eats away at it, is tiny, barely above zero.
And get this, over the long term, they actually get riskier. At the same time, their ability to zig when U.S. stocks zag gets worse. Now look at international stocks. Way higher real returns, they actually get less risky over time, and they stay uncorrelated with the U.S. market. That makes them a much, much better partner for diversification.
So here's the big takeaway from all this data. When you're talking about a multi-decade timeline, the real risk isn't the stock market bouncing around day to day. The real risks are inflation, silently destroying your purchasing power, and simply not having enough growth to fund your retirement. And in that fight, bonds are a surprisingly weak tool, while a globally diversified stock portfolio becomes the much safer bet.
So what do you do with this information? Well, it's not about panicking or making any rash moves. It's about understanding that the fundamental rules we were given might be based on an incomplete picture. And of course, we always have to remember that what happened in the past isn't a guarantee for the future. Let's just recap the big points we covered. This data suggests that an all-equity portfolio, heavily leaning towards international stocks, beat the standard target date fund on almost every metric that matters. You end up with more wealth, you can draw more income, and incredibly, you have a lower chance of running out of money. It forces us to ask if we even understand what risk and diversification really mean over a lifetime.
Ultimately, this research doesn't give you a simple answer. What it does is give you a really powerful question to ask yourself. It suggests that these safe paths we've all been told to follow might not be nearly as safe as we think. And when your financial future is on the line, questioning the conventional wisdom might just be the smartest thing you can do.